Well, analysts are continuing to pound on the buy ratings on Facebook. There's the stock. They've been right today, up close to 6%. Welcome to Digits. I'm Simon Constable. And to talk about this sort of mantra of buy, 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 we've got Aaron Lucetti of the Wall Street Journal. Thanks for joining us. Facebook, of course, an IPO that didn't do very well last year based on its offering price, doing a little better so far this year, but we're one day in. This mantra of buy, 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 tell us about it.
Well, the analysts on Facebook were positive almost uniformly among the bigger banks, even though the stock went from 38 down to about 18 or 19 and then bounced back into the 20s. So it's another example of why, if you're dealing with Wall Street research, most likely you want to look beyond the rating and see what the trends are, like the lowering estimates on the revenues last year and some of the other concerns that the analyst raised.
Now, these big banks that have these buy ratings, which you'd think would mean buy the stock, are they the same banks that took this company public?
Well, we looked at all the underwriters, and there were 33 of them. The top three were the ones we looked at most closely, and they generated the biggest fees for bringing the stock public.
And do they all have buy ratings?
And they all had buy ratings.
Yeah.
Among the 33, we looked at all the reports that had come out from analysts that rate the stock as of the end of the year, and that number was around 60% buy reports.
Now, one of the things that is interesting with these investment banks have research departments, and they have banking departments that take companies public, but they also have asset management companies. Were they doing the same thing as the research analysts?
Not exactly. They started in various ways. They all took big allocations of the IPO at the three largest underwriters, but two of the three sold off a good chunk, and Morgan Stanley, the other lead underwriter, sold some, but not as much as the other two. So these are big, sort of complex organizations. They do a lot of different things. Sometimes they're advising investors to buy or sell. Other times their mutual funds are making their own decisions on whether to buy or sell. They do that separately, but it does create some tricky optics, if you will, in terms of them moving in different directions.
Let's talk about that optics, because we've seen still last year a lot of money, small investor money, left the stock market in favor of the bond market. Does this sort of play into that feeling that small investors can't trust Wall Street?
It's a very good point. I mean, Facebook was a tough deal for the market, the stock market, because you can index the market, you can sort of buy the market and look at it and forget it and come back in a year or two. But if you're a stock picker, if you're looking for companies that are going to make more money than the averages, this was a big opportunity missed. This was a company that was large, fast growing, big expectations, and because of the way it was priced and the way it came out, it turned out to be a big loser for a lot of investors.
And we just had a look at the 1 year chart there, but one of the things that it went public at 38 and then spiked up to into the 40s, and then if you were unfortunate enough to buy it, then it's really slid down.
Right now, I mean, the banks and others will say you have to have a long-term horizon, and in 5 years this may be a winner. Who knows? There's a lot of things that have to happen. They have to make
it could also
the
be
right
non-existent.
calls.
I mean, tech companies go like that.
It could go either way. But in a 1 year time horizon, or about a 7 month time horizon, it hasn't been a great start, although it's having a nice bounce back today for various technical reasons. The tax loss selling has ended from last year, for instance. But in terms of why you'd want to get in on this company, the whole IPO market has changed somewhat for a large, mature company like Facebook that didn't even want to go public as much as, say, companies 10 or 15 years ago. A lot of private rounds of investments had been made. A lot of people who wanted to get in the stock already had. So as people look back on this company and why it went public at a price that in retrospect looks too high, a lot of people say, well, a lot of the demand was already filled. People got their shares beforehand, and so there weren't as many buyers left to drive up the stock after the IPO.
Now, back in the tech bubble, in the wake of that, we had prosecutors saying, well, look, you were privately sending emails, and I mean, someone else were privately sending emails while they're saying don't buy the stock, and then putting a buy rating on. Now, this isn't quite that, but you do have the same company sort of dumping stock, in the asset management side, just like saying, oh, let's throw it out the window, and you've got the analysts saying buy. Do you think regulators will look at that, or are they going to say, well, that's just the way it is on Wall Street?
That's a very good question. I think the regulators will want to make sure that those decisions were made independently. The other thing regulators look at is if the funds buy a lot of shares because it's a banking client. There's no sign that happened, although Morgan Stanley had big positions and held on to a lot of them. So there were believers in the stock both on the banking side and on the fund side.
And that's consistent. And even if they're losing money, that is consistent.
Indeed.
It is. Thank you very much.
Great
Aaron
to be here.
Lucetti of the Wall Street Journal. You can read more on that story by Aaron, Joe Leitner, and Anders Skaggs on WSJ.com. I'm Simon Constable, and that's it. That's Digits for now.